Call the meeting to order.
David Harrington.
Here.
Herman Covey.
Here.
Mark Gardner.
Here.
Landon Moore.
Here.
David Holly.
Here.
Mark Munson.
Here.
Laura Bellin. Councilman Glover.
Here.
Derek Challenger.
Present.
Solomon Ashby. Elizabeth Gooden.
Present.
Cheryl Spivey.
Here.
We do have a quorum.
So the first item is the approval of the minutes from the prior meeting. Does anyone have any questions or corrections? Do I have a motion to approve?
I move that we approve as written. Second.
All in favor?
Aye.
Aye. No?
We have three individuals that have reached vested status. They're all in the fire and police system. Gene Cooper, George DeBrow, and Wanda Griffin. We have had one reported death, James Gray from the Supplemental with a 50% spousal annuity. Active participants as of February 1st, fire and police has 20, Supplemental has 14.
Is that it for the applications in
Yes.
section 4?
Yes.
You want to take us through the fund flows?
Certainly. As of December 31st, year to date, our beginning balance, $219,110,313.57. We have had interest income of $3,426,337.97. And administrative expenses, $54,558.19. Investment management expense, $33,400.47. That's the right line. Retiree return of benefits, $10,906.94. Recurring benefit payments, $15,290,216.70. Realized loss of $422,630.10. Unrealized loss of $16,297,950.99. That's a net change for the year of $28,661,511.54, leaving us with an ending balance of $190,448,802.03. That is a change from this time last year of $40,902,552.06 less. Next is the statement for the OPEB trust. As of the end of December, the value was $2,998,405.42.
As we move into new business, could I make an introduction?
Sure.
And have some business, internal staffing business. First I'll say this will be Gail's last meeting with the retirement board. And so I wanted to say thank you for everything that Gail has done since she's been in this capacity. And training for Gail this meeting. Misha, would you stand, please? Can you hear me? Is Miss Misha Vargas. She is a fairly new employee. Joined the city in early December, and she comes to us from the Norfolk Airport as the executive to the CEO, and she's handled boards, been the executive secretary for boards in the past, and she will replace Ms. Mosher in this position beginning next month.
That does have to be voted on per the bylaws.
Okay. Well, thank you for your help with the board. Do we have any discussion? Do we have a motion to approve the change?
So moved.
Second.
All in favor?
Aye.
Aye.
Motion's passed.
We're going to miss you.
Indeed.
And my pleasure.
Bigger and better things, I hope. Do we have it, not to go back, but do we have any other comments, discussion on the OPEB trust? Next item, the John Hancock invoice.
There's 2 invoices. They're for administrative services. I attached them for your, so you can see them. I will let Irene Burns at John Hancock know that she can put these through for payment.
And this doesn't need to be voted on, right?
No.
Just, I've got a question just for
Sir.
my information. Is this generally a quarterly fee?
Yes,
It is? Okay.
Yes.
And it stays about the same, or is it based on balance?
it's based on balance.
Okay.
I'll go over it
Okay.
a little bit on how it's calculated for you.
Thank you.
Sure.
All right, next up is the quarterly review, but before we get into that, I wanted to first take a look at this memo that everyone has.
Let's see if I can reach Laura again.
Okay.
Who are you trying to call?
Laura.
Oh, okay.
To listen in while she was
Listen in.
on vacation. Somewhere in South Carolina.
Hello.
Good morning, Laura.
Good morning, Gail. I don't know what happened to the first couple of calls. Good morning, everyone.
Good
Good morning. Well, we have a quorum, and we've gone through a couple of the items on the agenda, the fund flows and the retiree applications, and we're about to move on to the investment review.
Sounds good.
Right now, so what you have in front of you is just a summary of a change that's being proposed to the investment policy. Part of the changes reflect the change in mandate that we've given to Greystone to manage the assets via the discretionary relationship. And the other change there is laid out in the front and also in the document, a slight tweak to the asset allocation target that Greystone recommended. It is the alternative investments line item at the bottom increasing that target from 2% to 5%. And that is coming out of the fixed income allocation. So not a big change there, but it's something that Greystone asked for, and I'm sure Brian can explain if you want briefly of why you asked for that.
Sure, happy to. As Landon talked about, we are proposing a change to the investment policy statement, and this was really driven by a meeting that we had with the investment committee in early January to review, given that we're operating under a new sort of mandate and relationship with the city of Portsmouth, some potential changes we wanted to make to the investment program. You can see it's pretty modest, moving 3% out of fixed income into alternative investments, and it's really driven by, I would say, two primary factors. One, we don't think that the returns from fixed income as we look out into the future are going to be terribly compelling. So we think we can generate some extra return by moving a little bit out of fixed income and into alternative investments. The second issue with respect to the ask of the board is we think we can further add diversification to the portfolio. So smooth out some of those peaks and valleys that inevitably we experience over time. It's a small amount, we acknowledge, but part of the reason that it's so small is, number one, we think we can get a decent benefit with a small allocation. But number two, as Gail was going through the historical fund flows, the thing that caught my eye is, at least in the first 6 months, about $15 million in benefit payments coming out. So you annualize that, it's about $30 million. That's a big chunk of the plan, and so tying up more money in these illiquid types of investments doesn't make a lot of sense to us given the cash flow dynamics of the plan. So that, at a very high level, kind of what we talked about with the investment committee. They were, I won't put words into the committee's mouth, but I think there was some comfort around moving in this direction. Happy to answer any other questions that anybody has.
Could you explain to me what makes up alternative investments?
Sure, yeah, that's a very good question. So alternative investments can be a catch-all category, basically anything that's not publicly traded stocks and bonds. We did put some language in here about what the composition of that portfolio is likely to look like. And at this point, we are thinking a small amount of hedge funds. There are some private credit investments. We think that there's some opportunity to generate some higher yields and higher levels of return from that. So as far as alternative investments go, the kind that we're likely to invest in are more liquid than things like private equity, where you're tying your money up for 10 to 15 years. You don't have immediate access to the money that we're likely to, in the strategies we're likely to utilize in the space, but it's not these really long-lived assets that are going to be around for 15 years and there's nothing we can do with it. If a year, 2, 3 years down the road it's something we want to change, we're able to do that.
What's the risk factor in dealing with hedge funds and other alternatives?
Yeah, so there's a number of risks that hedge funds present. Number one is sort of illiquidity. They're not as liquid as public markets. But that is also a benefit to hedge funds. They can pursue certain strategies that traditional investment managers are not able to pursue because they're not like a bank, like a mutual fund is, where a client can call up and say, give me my money tomorrow. They can put in their portfolios some more interesting, unique, and dynamic investment strategies in light of that. There's certainly higher fees that come with these kinds of investments. And a lot of the return that comes from hedge funds is really going to be concentrated on the skill of that individual manager. When you're investing in public stock and bond markets, rising tide lifts all boats. So if the market is doing well, even if you have a manager that isn't sort of the best and top notch, they're still going to do relatively well. With hedge funds, you're relying almost exclusively on the skill of that manager. So if markets go up, you hope they participate, and if markets go down, you hope they make money too. So there's a lot of reliance on the skill of that individual manager. Much of the success from investing in hedge funds comes from how you put the portfolio together and whether you have access to those top tier managers. I don't even know what the number is today, 6,000, 8,000 hedge funds out there. I can tell you if you're investing in hedge fund 1,000 or hedge fund 8,000, you're not going to be happy. But through the relationships that Morgan Stanley has, we believe we have access to some of the top tier managers out there that have exhibited an ability to consistently generate strong returns over time with relatively small amounts of volatility. So in the grand spectrum of what we might invest in, there's low risk hedge funds, there's high risk hedge funds, and by risk we're talking about volatility. We would err to the more conservative side. So we're not going to shoot the lights out with 30, 40, 50% returns. But if we can generate a return between stocks and bonds with very low levels of volatility, that's what we're trying to achieve.
So we've been assigned your top-tiered analyst.
I'm sorry?
We've been assigned your top-tiered analyst, is what you're telling me.
Well, we've got a number of people that look at this space. So it's not just one person. It's I would say dozens. Yeah.
And we're only talking a 3% change in
That's right.
Allocation. So
It's pretty small.
it's kind of allowing you to be a little bit more flexible with
That's right.
with the money.
And as we think about, not that we should do or implement the strategies that other public retirement systems follow across the country and here in Virginia, but it's a very, very common approach in terms of alternative investment strategies in the public retirement system space. And this is one thing we talked to the investment committee about in January. I think on average, the other Virginia municipal plans are probably north of 10% in hedge funds. Again, we shouldn't do things just because other public funds do them, but we think there's a strong investment thesis behind why we would want to do something like this as well.
I think that the investment strategy policy, the statement of investment policy that you collaboratively come up with, I think it strikes the balance that we're looking for. Mm-hmm. Our task is to protect the interests of current and future beneficiaries, which is us striking the balance between not being too risky, but also making sure that there's as much money there as long as possible. And I like the work that I saw, and I would agree with the changes that have been proposed.
Any other questions or comments? I'll also add that staff and Mr. Challenger reviewed the document as well. So if there's no other questions, can we have a motion to vote?
I move that we adopt the statement of investment policy as presented, dated, modified February 14th, 2019.
Second. All in favor?
Aye.
Anyone not in favor? All right, motion's passed. And with that, I think it's on to Greystone.
Performance time. Well, thank you. And it's good to see everybody again. For those that don't know me, and this is the first meetings or among the first meetings that you're at, my name is Brian Birnbaum, and I'm an investment consultant with Greystone Consulting based in Chicago. For those of you that do know me, you typically see somebody else sitting here, Jim Whitney, who's a partner of mine. Sadly, Jim had a meeting yesterday that ran a lot longer than was expected, and he was unable to make his flight. So he sends his regrets and apologies. He will be here at the next meeting, but I just wanted to let you know why he's not here. He had a prior commitment. So if I can ask everybody to just pull out this report, fourth quarter 2018 performance evaluation for the Portsmouth Fire and Police and Supplemental Retirement Systems. We're going to talk a little bit about, just kind of remind you about what happened in particularly the fourth quarter of 2018, but we can certainly talk more broadly about that as well for the full year. And then talk about what our outlook is for 2019, and then focus on total fund results. I'm going to say things that are going to be a no-brainer to everybody in this room, because I'm sure you've all sort of seen what happened. And behind tab 1 on page 3, I'm just going to sort of relive a difficult, to say the least, market environment from the fourth quarter of 2014. If we looked at the equity markets, the S&P had its worst quarterly return since 2011. The S&P was down about 13.5% in the fourth quarter, and a lot of that underperformance or negative returns was concentrated in the month of December. The month of December, the S&P was down almost 20%. So to say it was a difficult quarter is sort of an understatement. Now, there were a lot of things that were going on throughout 2018, but sort of acutely focused in the fourth quarter of this year. Number one, the Federal Reserve during 2018 was hiking interest rates. And I think what had happened is the market was perceiving that the economy was slowing, and yet the Federal Reserve continued to hike interest rates into a slowing economy. That caused a lot of consternation. It caused a lot of concern, particularly concentrated in the month of December. There was and is a slowing economy. If you just looked at the individual quarters during 2018, the fourth quarter GDP growth was 4.2%. The third quarter was down to 3.4%. For the full year, we think economic growth for 2018 is going to come in under 3%. And then as we look out into 2019, our expectation is that the economy is going to slow even more. So it's really difficult, since equity prices follow corporate earnings, which tend to follow economic growth. When you have a decelerating economy, it's really challenging for equity prices to rally. And so I think there was a realization that the economy was in fact slowing, and there was some concern around that. The last thing I would say, and this sort of feeds into part of the reason why the economy was slowing, was that there continued during the fourth quarter to be saber-rattling uncertainty with respect to the United States trade policy with other countries, particularly China. You would see seemingly on a daily basis new tariffs slapped on Chinese goods, or a new debate around trade policy with other countries. And so in light of that, a lot of companies have experienced some challenges with their businesses, particularly in China, because it's becoming much more difficult for companies to operate in light of this sort of trade dispute that's going on at the sort of national level. The other thing that's happening in China, quite frankly, is their economy is slowing too. And so that has presented challenges for a lot of companies that have a significant portion of their revenues coming from some of these countries. So there's a wide, swath of things that were going on in the fourth quarter, really concentrated around around the slowing economy, and there's, as we talked about, there were a few reasons behind that. We're going to talk about a little bit about returns, but the U.S. was one of the worst places to be in the fourth quarter. It was, as I mentioned, the S&P was down 13.5. When we look at small cap stocks, you're going to see them down 20. So again, a really challenging quarter. Developed non-U.S. markets were down 12.5%. Tough to get excited about something down 12.5%. It was down 1% less than the U.S. market was. And I'm not making light of this at all by any means, because we're faced with a very serious responsibility here on behalf of the beneficiaries. But the lone sort of star in the fourth quarter, quite frankly, was emerging markets. They were down 7.5%. So about half the decline that we experienced in the U.S. equity market. And just to remind the board, we have a fair amount of money invested in emerging markets. So we can talk about, and we've talked about with this group, why we think it's important to have a meaningful allocation there. But that higher allocation than normal helped us a little bit in the fourth quarter as those markets went down less. If I can ask the board to turn to page 5, again behind tab 1. Here are the returns of major U.S. equity market indexes on the bottom of page 5. We talked about the S&P 500 down 13.5%. Every sector of the U.S. equity market was down with the exception of one, and that was the utilities market. Utilities were up about 1.5% during the month of, during the fourth quarter. But every other sector of the U.S. economy in the U.S. equity market was down. Things like consumer staples and healthcare and real estate were down less. Those tend to be more defensive sectors of the economy. They don't go up as much when the economy's roaring, and they don't go down as much when equity markets are weak, and that's what we saw in the fourth quarter. Energy was down almost 25% in the quarter. Consumer discretionary technology all down double digits, mid double digits, call it 15 to 17%. I sort of highlighted this in comments a couple of minutes ago, but if you go down to that table, in the middle of that table, you'll see something called the Russell 2000. That's an index of small cap stocks in the U.S. You can see it's down 20%. So as a general rule, the riskier the stocks, and small cap stocks are riskier than large cap stocks, the riskier the stocks, the greater the decline in the fourth quarter. So if you look for the full year for 2018, the S&P was down about 4.5%, the Russell 2000 down about 11%. So up until really sort of the middle to the end of September or so, U.S. stocks were looking pretty good. They had positive returns, but at the end of September is when the market started to decline. All of the losses we saw in 2018 were really concentrated in that fourth quarter. On page 6, we take a look at non-U.S. equity market returns on the table on the bottom of that page. That MSCI EAFE index, this is a market of developed market countries. So think about the United Kingdom and Europe and Japan, countries like that. They were down 12.5%, down 13% for the year. And as I talked about, emerging markets in the fourth quarter, all the way at the bottom of that page, down about 7.5% for the quarter, but 14% for the year. Part of the declines in non-U.S. equity markets were and are attributable to the fact that the U.S. dollar has been so strong, particularly in 2018. When the dollar strengthens relative to other foreign currencies, the fact that we have U.S. dollar assets but are investing overseas, when we bring those returns back to the U.S. dollar, when the dollar is rising, that hurts our return. Part of our outlook for 2019, and the dollar strengthened largely because, well, for two reasons. One, The economy in the United States isn't as growing as strong as other countries, but it's in relatively good shape. So that's good for the U.S. dollar. That means that the dollar probably strengthens. But a more important contributor to the dollar strength was the fact that the Federal Reserve was raising interest rates. That means that foreign investors tend to put more money in the United States because they can get a higher yield on investments because the Federal Reserve is rising interest rates, and so the demand for those dollars from foreign sources are increasing. That means the dollar goes up. Part of our outlook for 2019 is we think the dollar has peaked. There's been a fairly significant shift as we look out into 2019 from the Federal Reserve, and this was only a few weeks ago in early January where the Fed chairman had come out and said, we're probably going to start slowing the rate of interest rate hikes. Because I think, well, we can debate whether it was the president forcing him to do this or whether he really thinks it, but what seems to be happening is the policymakers are starting to realize that, in fact, the economy is slowing, and so you never want to hike interest rates into a slowing economy. That's a really bad thing. It exacerbates the slowdown in economic growth. So with the Fed on the sideline and potentially cutting interest rates at some point in late 2019 or early 2020 to stimulate the economy, we think that means that the U.S. dollar is going to go down from these levels, or at an absolute minimum be stable. We don't expect to see the level of dollar strength that we saw in 2018 and 2019. On page 7, this takes a look at fixed income indices. That first one, this Bloomberg Barclays Capital U.S. Aggregate Index, this is a broad index of investment grade bonds. It includes government bonds and investment grade corporate bonds, mortgages. It was up about 1.6% for the fourth quarter. For the full year, it was basically flat. So we had negative bond returns in the first 9 months of the year. And then that was offset by a 1.6% return in the fourth quarter. The one right below that, I'll just mention this, we don't have any exposure here. But this Bloomberg Barclays Capital High Yield Index, so these are junk bonds. And junk bonds act more like stocks than they do traditional bonds. So when the equity markets are weak, typically what we see are high yield bonds being weak, and with the S&P down 13.5%, not terribly surprising to see a high yield market that's down 4.5%. So again, we don't have exposure here, but I just kind of wanted to give you a sense as to what was going on in the bond market. There's an interesting chart if you flip ahead to page 11. And this really highlights what a tough year 2018 was. And we go, this chart looks at, on a calendar year basis, different equity and bond market indices around the globe. And it looks on a calendar year going back to 2006. And if the index is colored in green, that means the return that index experienced that year beat the rate of inflation. If it was red, it means that index's return did not beat the rate of inflation. And the interesting, I think, part about this graph is if we go back to 2008, the worst environment that most of us experienced in our lifetimes, there was somewhere to hide. You could go into treasury bonds or fixed income investments and generate a return. Equity markets were down 40%, right? But you could go into bond markets and protect capital and actually generate a return. We didn't have that in 2018. There was not a single asset class globally that beat the rate of inflation. I think that just highlights what a challenging year 2018 was.
Brian, let me ask you a question on the high yield. You mentioned that we currently do not have exposure to high yield. Do you have the latitude to, at any point in time, to get into high yield?
Let me just check one thing. We do, I believe. We do. I was just seeing if
Okay.
there was there's not a prohibition on it. So we would use that flexibility
Right.
at the right time. What happened in December was, well, really kind of going into December, credit spreads, and credit spreads are the extra compensation we get over treasuries from taking credit risk. That extra level of compensation was really, really skinny. And relative to historical norms, it was well below the historical level of compensation we should receive for taking on that risk. In December, when everything sold off, those spreads widened, but they didn't widen enough in our view. They just got back to sort of the historical averages. We're looking for an opportunity where that level of compensation sort of dramatically exceeds what the historical level of compensation was. We're not anywhere near that point. When we would expect to get to that point when the economy is really weak and potentially entering a recession. We don't see that coming certainly in 2019, but over the near term. But we would absolutely take advantage of that discretion. If I can ask everybody to flip ahead to page 19, and it sort of, I'm sorry, to page 9, back to page 9. It's sort of another comment on 2018, but it starts to get into a little bit of our outlook as well for 2019. So this is a chart on page 9 that goes back to 1980. And typically what we see in a year is that at some point during that year, equity markets pull back by about 10%. Now, I know 2017 was sort of a long time ago, and that pullback of 10% even happens in years where the market's up 30%. There's some point in the year where the market becomes concerned about something and markets sell off by 10%. If we go back to 2017, which is the second blue bar from the right-hand side here, the S&P was up 19% that year. But the biggest drawdown from a peak to some trough was only 3%. So I think 2017 sort of lulled us, I'm using us broadly, but lulled the market into this false sense of security that volatility is dead, we don't need to worry about it anymore, and we think that's a bunch of nonsense. Now what we saw in 2018, we saw a 10% decline from peak to trough. In the month of February, we recovered. And then we saw a 20% decline in the latter part of 2018. So it's interesting, you look at 2017 and 2018 combined, looks like kind of an average year. But we had two of those big drawdowns in 2018 and none in 2017. We think 2018 and the volatility that we experienced in 2018 is more normal and something that we would expect to see in any year, even when we would expect pretty strong equity market returns. And that sort of gets into our outlook of 2019. So we think the economy is slowing for sure. We do not believe the economy is entering into a recession in 2019. We think U.S. stocks can probably do about 10% this year, and that. And we had that view, by the way, before January came. So we put out these views at the end of, in December when everything was going on. And we sort of had a snapback recovery in equity markets in January. We'll talk about results for the total fund in January. By the way, they're pretty good. But we don't see a recession coming anytime soon. The declines we experienced in December and in the fourth quarter we thought were pretty healthy. So from a valuation perspective, so how much the market is willing to pay for future growth, the declines we saw in December, I think, and we think, fixed a lot of some of the excesses that were starting to build up in the U.S. equity market. Yes, sir.
To your point, when you say that what you guys are seeing in the markets, is a slowing of the economy.
Yes.
What parameters do you all view or look at in terms of determining if a recession is on the horizon or it's headed that way? I mean, what kind of specific things do you look at?
Well, we certainly look at expectations for corporate profit growth, which is sort of the result of what the underlying economic activity looks like. We look at the ability of companies to finance their operations through issuing new debt. We look at things like consumer sentiment. We look at what's going on from a geopolitical perspective. So I wouldn't say there's a single data point that gets an outsized focus from us, but it's this mosaic we try to build from pulling in all sorts of different things to understand what's really going on in the underlying economy, what the unemployment situation is doing. So there's a lot of different things, but it sort of gives you a little bit of a sense of that. So if we're not entering into a recession in 2019, that doesn't mean that equities can't go down, though. So I'll tell you one thing we're watching closely, and one thing I think that the market is not paying close enough attention to. So as companies are reporting earnings now, and have been for the last several weeks, the earnings that they're reporting from the fourth quarter of last year have been pretty good. A lot of companies are showing top-line growth. A lot of companies are showing margin expansion and earnings per share growth from their businesses. Now, there's some that are facing challenges, but by and large, the earnings reports that are coming out for the fourth quarter of last year have been strong. However, what companies are doing is they're ratcheting down expectations for 2019. So, and I don't think the market realizes that or is paying too much attention to that. So the way we think 2019 is going to unfold is that we've had the snapback recovery. We're a little concerned that corporate earnings are not going to be as strong as the market expects. And once the market realizes that, we wouldn't be a bit surprised if the market sells off and we retest those lows that we experienced in December. So in light of that, we're being a little bit more cautious. We're being a little bit more thoughtful on moving money to certain areas of the market because we think we're going to have that opportunity to do that more cheaply at some point in the first half of 2019. We still think 2019 is going to be a pretty good year for U.S. stocks, up 10%. We think non-U.S. stocks, depending on which area you're talking about, could be 11, 12, 13%. So we think 2019 is going to be a good year for stocks, but we think we're going to have that more normal year in terms of volatility where we have that 10% plus drawdown at some point in the year. We think that's probably going to happen in the first half of 2019. So there's a bunch of other charts in here that kind of highlight what I just kind of talked about at a very high level. On page 16, if you this highlights what I mentioned in terms of our concern about corporate earnings growth. On the left-hand side, you can see a lot of those lines, and it doesn't really matter what region of the world you're talking about. Those expectations for corporate earnings growth are coming down. So you might hear the term recession thrown out in 2019, but what the media and the pundits will talk about is this earnings recession, where corporate earnings growth declines from what it has been in the recent past. Again, we don't think it's going to result in an underlying sort of recessionary environment in the U.S., but we talk about flexibility in high yield bonds. We're likely to be flexible around this dynamic of a weak half in 2019 and a much stronger half in the second half of 2019. Any questions about that before we get into results? Oh, but this is an interesting graph on page 17, by the way. This is something we've talked to the board about in the past. Here's the relative performance of U.S. versus non-U.S. stocks. You can see they go in cycles. When that blue squiggly line is trending downward, that means U.S. stocks are outperforming non-U.S. stocks. You can see the U.S. equity market has gone through sort of a protracted period of outperformance. We think that's likely to turn. And again, a big reason why we think that's likely to return is because the dollar shouldn't be as strong as it has been, particularly with the Fed on the sidelines and not hiking interest rates and potentially lowering rates later this year.
So do you think Europe and China or Asia in general will strengthen toward the end of this year, or the economy is not real good in either area of the world right now?
It's not. Now I'll just make a couple of comments about Japan, China, and then Europe. So China, yes, the economy is slowing. The economy is growing probably around 6%.
Yeah.
Still a lot higher than what we're experiencing in the developed world, but China's got a problem, a potential issue around its debt levels. There's still, we think, sufficient room for the government to stimulate the economy in China, and they're probably going to do that. Once we get beyond, these trade negotiations and a new trade agreement in place, I think you're likely to see more action from China in terms of stimulating its economy. That should be pretty good for Chinese stock prices, and they have been pretty good for this year already. Japan's an interesting one. You talk to managers out there, and you have some that say this is the greatest buying opportunity in my career, and you have some that say Japan is always weak, and I'm never going to touch it. And so you try to sift through, some of that noise. I think the biggest thing going on in Japan is there's been a trend for massive corporate governance reforms where companies in Japan are now interested in making money where they hadn't been in the past, believe it or not. And so we think there are some compelling opportunities. And Japan is perpetually cheap, so it looks attractive from a valuation perspective. But if we can get this change in sort of cultural dynamic at the corporate level, could be a really, really interesting opportunity to be investing in Japan. We got a little bit of exposure there, not a huge amount. Europe continues to be sort of mired in problems, slow growth. The thing with Europe is that you look across any major capital market in the world, it is by far the cheapest region of the world. But it continues to get cheaper. And so, again, there's an area that we look at. There's a lot going on with Brexit. We think that's noise more than anything. Things will get worked out from a long-term economic perspective, not likely to have a material impact, but it's going to add short-term volatility. There could be some opportunities to step in and be flexible. We're certainly not overweight Europe at this point, but we'll sort of wait to see how that dynamic plays out. So if I can ask the board to flip behind tab 2, and this is a little bit new report that we're going to look at, and I just want to highlight sort of one dynamic here. So as Mr. Moore talked about at the outset, part of the reason why we recommended some changes to the investment policy statement is because our relationship has changed. In the past, we were your consultant. We provided advice and recommendations, and you either took those or you didn't. Effective November 1st of last year, our mandate changed to be one more of a discretionary advisor. So within the confines of the investment policy statement, we have flexibility to move to certain areas of the market. We now have flexibility to hire and fire managers without bringing that recommendation to the board. And so we're starting that performance track record as of 11/1 of 18, because that's when that relationship started. And so we're going to talk about, we talked about a lot of what happened in the fourth quarter, but the results we're going to talk about were really 2 months. Okay. So on page 23, here are the returns for the consolidated plan. So as Gail talked about, assets in the plan total about 188, little bit north of $188 million at the end of the year. So for that 2-month period, most of the fourth quarter, but that 2-month period, our return was down 3.27%. This is net of all fees, but we were down 3.27%. Not bad, considering the S&P was down 7. If you go all the way down to the bottom of that table, the City of Portsmouth IPS, this is the benchmark that we measure ourselves against. And let me kind of describe what the benchmark is. We have target allocations to things like U.S. stocks and non-U.S. stocks and bonds. And we say for this benchmark, we say, okay, let's assume we were at those target allocations. And let's assume we earned the broad market's return in each of those asset categories. What would that return have been? And that's what that minus 3.44% is. So how do we outperform that benchmark? There's a couple of things. One, we can have different allocations than our targets to the different asset classes. Maybe we want to overweight non-U.S. stocks. Maybe we want to underweight fixed income. So that can have an impact relative to that benchmark. The second area that comes through is we earn, in most of the asset classes, we earn a return that's different than the broad market index. We hire active managers to be able to beat the market. Some of them do in certain periods, while others don't. Over a long period of time, we have a pretty high level of confidence that those managers that we have in place are going to outperform the market. So that relative performance difference from active managers that we're getting comes through here. So the combination of those two things, our managers doing better than the market, and the fact that we might have had slightly different exposures and allocations than our targets, driving that difference in return. We show a performance since sort of the middle of 2016. This is when we joined Morgan Stanley from Credit Suisse. So you're always going to see this one. Compliance makes us put this one in there. But keep in mind, we certainly didn't have discretion in there. We didn't have full purview of assisting the board across all elements of the investment policy back then either, but it shows up. Since then, our return was a little bit north of 5%. I'm going to ask you to flip ahead to slide 26. So this looks at our actual allocation relative to the investment policy targets that were in place as of 12/31/18. Now, granted, these are going to change a little bit based on the decisions that the board made. But there's, in the actual allocation, you can see, if you compare those two pie charts, that green bar looks a lot skinnier than the target, and that blue bar, or purple, looks a lot bigger than the target. There's a couple of goofy things going on in there that makes that look that way. There are two investments that Jim and I and our Greystone team considers that are in alternative investments that are fixed income. And that is called by our compliance group as alternatives. And I'll tell you what the two are, just so you don't become overly concerned. One is a Templeton Global Bond Fund. It's got bond in its name. It buys sovereign bonds of U.S. and non-U.S. countries. That's a bond fund. Those are bonds. For whatever reason, somebody else says, no, that's an alternative. Okay? The other one that's in there is another bond fund. It's called the Carillon Reams Unconstrained Bond Fund. They invest in bonds. The prospectus is written incredibly broadly, like any mutual fund investment, that basically says you can invest anywhere you want. And so, again, that is categorized for compliance purposes under alternatives, but it is a bond fund. You make that adjustment, the fixed income allocation, our actual fixed income allocation was 25.1%, and our alternatives allocation was 5.6%. So relative to our targets, we were spot on. So that relative performance difference between our total fund and that benchmark going to be driven by active managers, because we were basically right on the targets that we expected to be. So let's talk about the individual returns for that 2-month period, and then I'll give you an update in January. So the first one is that on the top of page 27, Schaefer Cullen, as you know, this is a manager that has been managing money for the city for a long time. We've significantly reduced the allocation to this portfolio over time. But in that 2-month period, their return was down 4% versus their benchmark of about down 5.7. So they outperformed. They protected about 160 basis points of value during that 2-month period. You'll recall this is a manager that buys large cap stocks, pay a lot of dividends, and then they write options on that portfolio to take some of the risk out of that portfolio. When equity markets are in decline, the defensive nature of that portfolio does pretty well, and that's what we saw in that 2-month period. I will tell you that this is a manager post-December. We had told them to stop writing options on the portfolio, and that ultimately we are going to move away from them into other more interesting strategies. So this is a manager that's on its way out, and you would expect to see them to go away and new managers come in place in the early part of this year. The next portfolio is this Vanguard Institutional Index Fund. It is a fund that's designed to track the S&P 500. So it will do so. It's not trying to beat the market. It's just trying to secure the market's return. Its return during that 2-month period was right in line with the S&P, 7.3 versus 7.2. The next portfolio down there, American Euro-Pacific Growth Fund. This is a non-U.S. equity manager. It's a manager we've had in place for a long time. They invest in both developed and emerging market countries. About a quarter of their portfolio, roughly, is in emerging market countries. They were down 3.9% versus down 3.6% for the market, so kind of right in line. Artisan Developing World Fund. This is an emerging markets portfolio, our active emerging market exposure. You recall when we looked at emerging markets, they were down about 7.5% during the fourth quarter. Interestingly, you look at Artisan's return, they were actually positive, 2.8% return during that 2-month period. And those markets in general were positive as well, up about 1.4%. So Artisan, our active manager in that space, not only generated positive returns, but generated returns in excess of the benchmark. BlackRock is a fixed income manager for us. They were up about 1.5% versus an index that was closer to 2.5%. They had a shorter maturity profile than the overall market. So when interest rates come down, like they did in the 2 months that we're showing here, bond prices go up. And the more, they call it duration, but the longer the maturity bonds you have in your portfolio when interest rates are going down, the bigger your price increase. So they had shorter duration, shorter maturity bonds than the overall index, so they didn't rally as much in that 2-month period than the index did. But when interest rates go up, this portfolio, at least the way they were structured in the fourth quarter, would do better. I will tell you, since the end of the year, this manager has extended the duration and got longer maturity bonds in their portfolio, so they look a bit more like the index, because it's their view, like it is ours, that interest rates are probably coming down a bit as the economy continues to slow. Lord Abbott is a short duration bond manager. They were up about 0.7% versus this index of 1. A little bit shorter maturity than the overall index and less in corporate bonds. We talked a little bit about high yield. We just don't think you're getting that level of compensation to take on that risk, and Lord Abbott kind of felt the same way too, so they had a little bit shorter maturity and a little bit less in credit during that period, which contributed to their 30 basis points of underperformance. Here's that Caroline Reams fund. They were a little bit ahead of the market. The next one is Rice Hall James. It's a small and mid-cap growth manager in the United States, and we know from looking at the results of those markets that those were among the worst returners during the fourth quarter. So Rice Hall James was down about 12. Their benchmark was down a little bit more than 9, so they underperformed by a little bit less than 300 basis points. This is a manager that we have a great deal of confidence in. It's a 2-month period, and we don't think there's any need to be concerned there. There's you can see the other managers down there, some of which had outperformed, some of which had underperformed. So again, you add all that stuff up, we outperformed at the total fund level by about 17 basis points. So, a good result. Nobody likes to be negative, but it's always good to go down less than what your benchmark goes down. So let me give you a sense as to what January looked like. And January was pretty solid. We talked about there was sort of the snapback recovery. The U.S. equity market was up about 8.5% in the month of January alone. Non-U.S. equity markets were up about 7.5%. Bonds were up anywhere between 1 and 1.5%, and REITs, which we have some exposure to, real estate investment trusts, they were up almost 11.5% in January. It's great. We love to see markets like this, but we think the market's got a little bit ahead of itself. And so, again, as we talked about, it wouldn't surprise us to see markets come off from these levels. We're estimating our total fund to be up about a little bit more than 6%. So if we were down in this 2-month period of whatever it was, 3 and change, 3.27, and we're up in January over 6, we sort of clawed our way back from those losses that we experienced. And February is looking pretty okay too. So these are just the numbers through the end of January. So with that, just a quick comment around some changes, as I sort of alluded to. We are in the process of moving some money around from some managers we don't want exposure to anymore, to those that we have a greater deal of confidence in, and in many cases, those which cost us less to invest with. And so when we come back at the next meeting to review first quarter results, there will be a number of new managers in place that we'll be talking about, but I just wanted to give you a heads up that that process is occurring as we speak. With that, I'll stop and see if there's any questions. Great.
Thanks.
Good job.
And with that, we have Tom Shanley from John Hancock.
Thank you. Thanks. Well, good morning again, everybody. Once again, my name's Tom Shanley with John Hancock, for those of you I haven't had a lot of interaction with. I am really responsible for all of the services that the pension system requires from an ongoing administration and participant services standpoint. We refer to ourselves and the way we're structured for you all as a bundled provider, meaning, for the most part, outside of investment consulting, everything that's needed to run the plan, we can take care of for you, or we will, assist additional parties when needed, such as audits, as an example. So Very thankful to be here, appreciative of this business. I've been involved with the relationship really since its inception with our organization, now right around 10 years. So again, always appreciate the opportunity to come down. Today, I'm going to give just a brief overview, a quick look back at 2018. I think it's important for the board that you recognize a lot of the hard work and efforts that you all did, and the administration and benefits group as well. Just want to document that. I'm not going to go through it all. We'll highlight a couple of points. And then, as I did last year and I try to do once a year, is just to give you a very brief overview of exactly what we do. Again, I won't go into significant detail, but if there are questions, please ask. From there, we'll just talk about, how we will continue to support through 2019. I do have some high-level plan or system statistics, and then I'll talk a little bit about, as I normally do on a quarterly basis, how our fee structure works. I know a question came up earlier, so just talk a little bit about that, and then also discuss a potential change with regards to not the fee structure, but looking to bring in a nominal fee just based off of some of the new investment strategies that'll be coming forward. So I'll talk a little bit about that as well. All right, so there's a good amount of material here, but I'm going to move through it quickly, but please ask questions as you have them. So I'll just jump to the back of tab 1. And over these 3 pages here, we listed out all the accomplishments from 2018. And again, this is from our perspective, partnering with you all. Won't hit on all of them. Some of these are kind of standard ongoing services that we provide, how we interact, and most importantly, how we service all the retirees and future retirees of the system. To highlight the main item down on page 6, last year we delivered over 12,000 benefit payments to the City of Portsmouth participants. If you take that approximate $30 million that was referenced from a benefits payment perspective, that's an average of over $29,000 per individual that we're paying. So, it's a great thing to step back and remember the tremendous benefit you're providing to all the former employees of the city and the ongoing oversight and the importance of that. We've worked with Ms. Gooden's team to look for some additional efficiencies on their side, looking to see how we can support a little bit further, work together to maybe reduce some of the ongoing administration. I think a benefit probably more internally to City of Portsmouth was a change to how additional credit union deductions were taken. We did introduce just a single opportunity for individuals to receive their benefit, and we did so pretty successfully. There wasn't a lot of pushback with that, and individuals still have, an opportunity to change where their benefit goes. It's just simplified the process. One of the other things we actually just introduced at the end of the year was an enhanced processing for terminated vested participants. You don't have a large group remaining there that haven't begun benefits, but what we did is we streamlined the process so the individuals will work more directly with John Hancock as opposed to coming to the Human Resources Group to begin their benefits. So still, obviously, you need to be in that process to approve, but we're taking on more of that ongoing interaction. A couple other things to point out. Bottom of page 6, I know last year Andre Stewart attended a public works session. Bottom of page 7 references a handful of additional analysis that Andre also put together through different requests that came through. And last year we also provided in this meeting, and I'll look to do that again this year, is just an update on our cybersecurity, since it's a very important point of consideration at this point, and all the different ways we protect the information for your individuals. On page 8, just a list of some of the ongoing participant communications. Again, with a frozen system that is primarily in pay status, there is not a tremendous need to do a lot of ongoing communication, but we do have services to help support there. We did come out down on site and took part in some employee meetings last year, and we also offered a couple via webinar specific to some of the changes that we're going through on the administration side, and then just to ask or to answer questions that individuals may have. And then we do have a core communications program that you all do participate in, and it allows individuals, if needed, just access to more financial wellness and tools and resources on an ongoing basis. Again, not as much interaction probably for a frozen system, but still some services that are there. Okay. On tab 2, just included a few slides here with regards to our organization, especially for those that haven't seen this before. So, John Hancock is globally owned by Manulife Financial, based out of Canada. We are one of the largest global retirement and wealth asset management firms in the world, and in the U.S. as well. So, if you look at the U.S. on the left-hand side of page 10, we oversee close to $170 billion in retirement plan assets in the U.S. We deal with over 55,000 retirement plans, and we service close to 3 million participants through that arrangement. We also have a large presence in Hong Kong, Indonesia, and Canada. And one of the main focuses of our organization is to grow the retirement and wealth asset management business. As John Hancock doesn't step out of the insurance industry, we're still very committed to insurance, but one of the key components is to grow the retirement side of the business.
And didn't Manulife have a acquisition of another company to combine with John Hancock that sort of increased your commitment to that space?
Yeah, well, so one of them actually impacted you all. In the U.S., it was John Hancock purchased New York Life's retirement plan business. That's where I originally came from. That's where the original relationship was here. And then in Canada, there was a large insurance acquisition of Standard Life that grew the business up in Canada.
And there are not many players in this space that are your size and depth and capability.
It continues to see consolidation, and yeah, especially with what we refer to as, well, pension servicing and total retirement servicing, where we work on the corporate side with both 401ks and pension business. There are less and less as we're going forward, and there's rumors of another big acquisition in the marketplace. Not with us at this point, but it does continue to look to consolidate. And that, on page 12 is just, I won't get into that, but again, that's highlighting what we refer to as total retirement outsourcing. So, more on the corporate side, where we handle 401k, executive benefit, non-qualified plans, and pension plans. And we can do that all off of the same operating system and same service teams to create efficiencies. In tab 3, just to highlight how the service structure is set up and what we do for the city. So you see a listing of service team members on page 14. Partnering with you all and with Greystone and Morgan Stanley. Again, I own the responsibility to ensure that everything is going as smoothly as possible, and we're working with you all to bring the right solutions. I work with a service team behind me. Irene Burns, who was mentioned earlier, is the defined benefit analyst. She handles all of the ongoing day-to-day administration and processing, working with teams internally to John Hancock. She works a lot with the HR group and with finance as needed. Andre Stewart, who many of you know, has been working on the relationship for a number of years as the assigned actuary. He also manages the actuarial team. So, in my opinion, you have the best of the actuarial team has to offer at our organization. Nicole Brejo works behind the scenes and supporting Andre. Carol Wilhelm assist with communications when needed, and we'll step in and provide resources, as those opportunities come up. And we do have an assigned individual from our investment services group. Quite honestly, really hasn't had to get involved with the relationship, but if Brian and his group, needs information from us or something that, I can't provide, we would look to pull Brian in. And so those are the main individuals dedicated to the relationship. Page 15 just looks at, all the different ways we focus from a high-level overview and the things we look at, from assisting with ongoing governance, plan investment support, looking to optimize cost, and engaging employees, when and as needed. So to hit a couple of those points on page 16, as I mentioned, we are a bundled provider. We offer integrated services, which means, again, everything that runs the system is all based through our record-keeping process, from an administration side, trust and custodial, feeding into, our actuarial systems that Andre ultimately uses to, work on annual valuations, et cetera. We do support an open architecture investment platform, meaning, we have thousands of agreements for mutual funds, and we fully support non-mutual funds in working with, how Greystone wants to move forward, setting up additional communications with other asset holders as that happens throughout the time period. And then, we pay all benefit checks. We do all tax reporting, and we work directly with all of the retirees throughout that process and then ongoing. Some of the actuarial support is referenced here on page 17. This is definitely one of the main differentiators for us as a provider, where we have a full actuarial team on staff, and we can all work efficiently internally and then with you all. Page 18 lists some of the administrative things that we do that I haven't mentioned thus far. And then on 19, it looks at some of the communications. So, when and where we do have to send out communications, we will customize them for the city. And then, as you can see on page 20 and 21, and as I mentioned, we have an ongoing program where we can offer additional services and then deal directly with retirees, vested terms, and actives. They contact us directly, either into our phone center or by web. So it was a quick overview, but any questions?
If retirees have questions, they should contact Hancock directly or go through HR?
Yeah, it's really, they can come directly to us.
Okay.
Yep. And we have wallet cards too. I'm not sure if you all still have a current
Yes, we
supply.
do.
Okay, so if they do contact the city, they can get a card, or, contact information is on materials as well. All right, so in tab 4, really what we're looking to do is to continue to support how we have been partnering into 2019 through the attendance at these meetings, providing the annual service structure, which I just went through. In the upcoming quarters, I'll look to give an update on new services and solutions that we're offering and how they can assist individuals. We'll also provide an updated data security overview. From an ongoing standpoint, as I mentioned, we'll look for administrative efficiencies. Quite honestly, there's probably not a lot left. There's always things we hope we can do, but again, with a plan primarily in pay, that process generally works well as long as we continue to get benefit payments out. We have assisted in the past with fiduciary training. I believe Mr. Challenger is looking to lead an updated training this year. We have supported next month.
Yeah, next month, yeah.
Okay, perfect. So I did share some of the information we used the last time, just to see if it could be of any assistance. And, if at any point there are questions or we can help, we're happy to do so. And then Andre will definitely be out here again, and we'll continue with the ongoing actuarial support, annual valuations, and working with your individuals. All right. We've already hit assets a couple of times here. And then in the appendix, these are just some of the ongoing statistics I provide. I won't walk through all of these, but it does list out quarter over quarter participant status breakdown and then, a breakout of payments and some of the cash flow. I know you get monthly updates for the board here, so this is just kind of a following record update. And we still continue to classify that one individual a little bit differently on our system, so that's why I know it's reported that there's 14 actives. We show 15. I believe it's due to an individual that's on a leave status. But what I did want to spend a couple of minutes on is page 36, 37, just to kind of provide another overview on how our expenses work and how, currently the system is structured. So John Hancock has a set required revenue. Our agreement is, for all the services that we provide, we charge 6.5 basis points on assets. That is calculated on a quarterly basis. That's a reflection of the invoices that are provided to the board. I believe on one side you see what the actual amount is, and on the other side of what's handed out is the calculation on how that's determined. It's essentially just taking that 6.5 basis points, looking at the number of days in the quarter, doing that math and applying it against average assets for the quarter to come out with the fee. We also report out, based off of ongoing feeds and information we receive, what the overall investment expense is for the plan, and then what that totals. Our fee schedules date back to July of 2014, and they are on a 5-year term. Within those and the additional services I talked about, we also, allow for 4 employee or retiree meetings a year if needed. That's where, again, we can send somebody down here on site or do webinars. And then we did build in the ability to support fiduciary trainings if needed. I can walk through just quickly how one of the line items work here on page 37. So if you just look left to right, this is looking just at the fire and police system, using Goldman Sachs as an example. So what this shows you is, there were 699 accounts within the pension system. The assets for quarter end 12/31 and for the Goldman Sachs was approximately 4.9 million, represented 4% of assets. If you move over to the right, the investment expense ratio for the Goldman Sachs fund was 97 basis points, 0.97. That's Goldman Sachs' cost to manage the money that's invested there. For a dollar perspective, that equates to $48,093. Now, some of the investment options have agreements with John Hancock where they will pay back what's referred to as revenue sharing. That revenue sharing doesn't go to us, it comes through us, but it goes directly into the plan to benefit and offset costs of the plan. You're only going to see those on some mutual fund options, and many, in a pension system will look to eliminate that to get to the lowest investment expense. But with that said, Goldman Sachs is currently sharing back 10 basis points. That's not 10 additional, that's 10 as part of the 97. So $4,958 comes back into the plan to offset costs. So if you bring all of that down to the bottom of the section there, you see total plants, total assets for the end of the quarter. And what this kind of does is it projects out, looking at an annualized basis for 2019. Assuming that the assets didn't change, this is where your projected expenses would be. So the overall weighted average expense of the portfolio would be just over 52 basis points, half of 1%. That equals out $735,172. Of that, 2 basis points comes back into the plan, or $28,157. Okay, if you bring that down to the table below, that $28,000 will offset what John Hancock's required revenue is. And you can see that as being, as I mentioned, 6.5 basis points or $91,143. So that means we would bill an additional $62,987, and that's where you would get those quarterly invoices that come out. Okay, and that's paid against the trust. So ultimately, all of this is being paid by the trust, whether it's an investment expense or the additional administrative expense. Any questions with that, how that works?
I had a couple of general comments. So the net of the revenue sharing, in 18, we paid around 50 basis points of investment management fees. And I think that is excluding what we paid to Greystone. Moving forward, Greystone's making some changes to the manager lineup. I believe the all-in fee, including Greystone, will be at or around 50 basis points going forward. I think it might be
slightly less. Yeah.
a little bit less. So again, back to the whole point of the new relationship, keeping manager fees low is important. As you see, it's $1 million between the two plans. Every basis point of fees makes a difference.
Yeah.
So Hancock will get 50 and then Greystone gets 50, is that what you're saying?
No, Greystone gets 10.
Greystone gets 10, and then the mix of the underlying managers we'll have in place will be about 40.
Okay.
So this that we're showing for last year, the underlying managers were
Okay.
getting 50.
All right.
And then John Hancock going forward, you said the fee schedule expires this year?
It does. So we continue, our fee schedule goes into evergreen status until the board or the city begins, a renewal process. Unless, we certainly can look to negotiate outside of that, but that has been the process the last time this came up.
So if we do nothing, not to say that we will do nothing, we would continue on the current fee schedule until the point of time where the city or the board renegotiates a new
Correct.
contract, I guess.
Yeah, and we're open to renegotiation this year. I would believe that, my understanding is that the city has a 5-year vendor agreement, so my understanding is we are up for review for services, but, we generally leave that for the city.
We'll take a look at that.
Who initiates that? The city or the board?
Administratively, it runs through procurement, so the city's procurement office. And I guess they're the ones who hold the contract. It's out for anyone to see. But so I was going to check with them to see what the dates are, because I'm unsure right now. But then it would be the board who would decide any actions if you want to go what type of process of either renewing or doing something different would be.
And just as a point of information, in that type of process, because it's under procurement, would that require an RFP? Would that require an RFP
For
process?
services, it'd probably be best for me to get Mr. Ammons to come in. He's the city's procurement officer, and is very familiar with Virginia law.
Sure.
And much more than I am. But he could come in, I guess, with Derek and probably answer some of those questions better than I could.
So we request for the next meeting for the procurement official to bring to us advice as to the proper way to proceed regarding the services agreement with John Hancock.
Yes, very good.
If we're required to do a full RFP or not.
Okay. Now, as I commented at the beginning, there is one fee item I do need to discuss today, and I've passed along some information a little bit on that. I don't believe it's reached the entire board, but so I wanted to talk about it during this meeting. So we have, as part of our existing fee schedules, and I think Gail, you'd printed out copies if anyone is interested in seeing it, but there are some provisions in there that talk to additional fees for non-mutual fund held investments or investments held away from John Hancock. And that is primarily due to the additional manual work that we have to do to support those investment options. So generally speaking, if a pension plan is holding mutual funds, those mutual funds run through what's called the NSCC, which is National Security Clearance, which essentially means that all the interactions between the fund companies and us as a provider are automated. So, and it also allows efficiencies so that, let's say, for example, you do hold the Goldman Sachs Small Cap Value Fund. What we're able to do is we have a number of other clients that also use that same fund. We net all transactions up through a daily process, and we send that information back and forth to Goldman Sachs. It makes it much more efficient. As you start to use investment options that are non-mutual fund options or options that are held at other custodians, then it does introduce manual intervention on our part to update systems. We do ongoing trust reporting. And then it also leads to the additional need to wire funds back and forth for rebalancing allocations or potentially to bring money for liquidity for payments. So due to that, there's additional cost per year of $2,500 for any investment option that is valued on a monthly basis or less, or $500 on any investment option that is valued on a quarterly basis or more. So we initially had made an exception when the city a couple of years ago had added, a new fund that was not held with us. But there's been an increase in those options, and there will be an increase in those options for everything, for all the right reasons. Just utilize more managed accounts and hedge funds with Morgan Stanley. But just due to that increase, we do need to introduce or start to factor in fees for that additional work. Again, it's not a significant amount. And I've been working with the folks at Greystone and Morgan Stanley's back office. Hopefully what we're looking to do is potentially use holding account that can hold multiple separately managed accounts in it, which would create like one feed for us as opposed to 5 or 6.
Yeah, so the idea right now in trying to mitigate as much as possible this extra cost to the plans would be for the assets that come over to Morgan Stanley to be invested in lower fee investment options, primarily through separate accounts. For the traditional asset classes, we throw it all into one account. And then we can do some reporting to say, okay, here's how much this manager has, here's how much that manager has. And then for the hedge funds that we talked about earlier today, all those would be thrown in one account. So we think, as of right now, there will just be 2 accounts at Morgan Stanley, one that holds traditional investments and one that holds hedge funds, and that would result in an extra $5,000 in fees. So it's not going to,
That's $5,000 a year?
Yes.
Okay.
It's not going to be a huge number, but as Landon talked about, look, any extra fee is, an extra fee.
Yeah, and like I said, we're having conversations hopefully structured in a way that it's most cost efficient. And then it gives flexibility, so if there's just one consolidated account at Morgan Stanley side, changes can be made without really impacting that structure.
And again, the fees, we're saving money on investment management fees. So I think probably net, we're better off, but there is this extra fee.
I'd just say that I would agree that on a total fee basis, we're still better off now than we were even with this fee. Also, the fact that we've actually already agreed to this fee in the fee agreement we're currently under. It's just that John Hancock hadn't been charging us for this fee and I don't know the history of why you didn't charge for it. And going forward, they're going to have to charge us for this, which Greystone's helping to mitigate the fee by that consolidation of accounting to pass the information to John Hancock. And then I guess going forward, whenever we get around to redoing the contract, this is something that we'll I guess, have to discuss.
Right.
Anything else for me? All right.
Thank you.
Thank you.
So if there's nothing else, I think that is it.
One question, Gail. I had emailed you, and you may or may not have received it, I don't know, a request to get a contact sheet for all the members of the board. Is that possible with email addresses and phone numbers?
I believe we had a question about that, didn't we, Derek, about the fact that if we pass that out, it becomes public as well?
Yeah.
What does?
Yes. Pursuant to FOIA request, yes, because it becomes a public document that we've created, yes.
Oh, okay.
It's better, I guess, just to go to each other and say, here's
Yeah.
my contact.
Go off the most recent email from Gail.
Yeah.
Okie dokie. Enough said.
Anything else? Do we need a motion to end the meeting?
Motion to adjourn?
Second.
All in favor?
Aye.
Thank you.
Thank you,
Good
everyone.
job.
I'm not used to all the formalities.